Hello, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. If we're not able to answer your question today during the webinar, go ahead and leave your phone number as well, and we will make sure someone reaches out to you after today's event. Once again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. We'd love to introduce you to today's speaker. Sean McElderry is the CEO and founder of Monarch Wealth and Retirement Strategies. He's a certified financial fiduciary and has over 22 years of experience in the financial services industry. As a financial professional, Sean and his team are committed to helping people create solutions for their retirement assets. And once they understand risk tolerance, time horizon, and goals, they work to develop a program that carefully balances investment strategies with preserving principal. And I'm going to go ahead and turn the time over to you, Sean. We're excited to have you here on a very important topic.
Thank you for the great introduction, Marche, and I appreciate your assistance in putting these together. So yes, it is an important and I think often overlooked topic. It's something that as we meet clients time and time again, we have the conversation about, these plans that the spouse or themselves have simply just kind of forgotten about, not necessarily forgotten about, or maybe don't realize that there are other options of what to do. So we're going to kind of get into the basics of that and also get fairly detailed so that we can help everybody from a high level, and then also kind of what steps to take as far as best practices and things to avoid. So the first thing is, let's just talk about, whether it's a 401k plan, or some of you might have 403bs or 457s, essentially any type of account that you're saving through your employer with. You might even have set some up for yourself if you own a company, but we'll talk specifically about, if you're contributing to an employer plan, what are these plans, strengths and weaknesses? And the first thing is, if you think about it, when these companies set these up, it's really designed to attract employees. It's a good retention tool so that they're competitive in their workforce. And so it's not necessarily that they're trying to give you the best of everything. And I think one mistake is people will often assume that because their employer puts this plan together that there should be some inherent trust, or that it's really good. They might have a great employer, but they might not really understand the pitfalls of the plan. Plans it's always better to put money in something, obviously, but you want to understand where you're going with that. So most plans are definitely designed for growth. If you think about it, many people started a company when they're young, and risk might not be such a concern when you're 20, 22 years old. But as we get older, we want to start, kind of eyeing on how can we put a plan together that's going to meet me through all levels. And not to say that these plans aren't designed for that. It's just the question is, they have all the choices. Most plans that we see are quite diverse in choice, but not necessarily giving you the ability to completely diversify in the best of every area. And so what we see quite often is when we look at these plans, there'll be a lot of choices that on the surface look different. But at the simplest level, if you think of you always see these pie charts. I know we love our graphs and everything, but if you think of the pie chart, you would in a best case scenario, have money in all those pieces. If you're trying to put them in all the pieces and you only have 3 pieces to pick from, then it doesn't matter how many choices there are, you're simply not getting full diversity. So we see this quite a bit where they're very heavy in those S&P 500 type stocks, the NASDAQ, maybe a sprinkling in the Dow, but they can often be very heavy in growth, which is what you saw in 2008. We saw people really get hit in those 401ks because they were pretty much tied to the S&P, and that's where you saw that big drop that people really get upset about. So how can we help buffer that, if you will, and still get growth?
I'm sorry, Sean.
Yeah.
We had a question here. Can you explain what are the general categories where you diversify a portfolio? So you said you have growth, and then what are the other categories?
Yeah, I'll give you the basic rundown, and in a minute I'll actually kind of just illustrate it briefly so you can visually see it. But basically you have growth and value companies, okay? And those are going to be in the U.S., and then those are broken down by large, small, and medium. So basically large, medium, small companies. And then you have international, which could also be broken down in a similar fashion, growth and value, small, medium, large. And then you're going to have your fixed income bucket. So in general, we like to think of it in the big sleeves that you're going to have 6 buckets in the U.S., international being 7, and fixed income being 8. And then there's always those kind of alternative pieces that are more preference and might be based around when you're planning to retire. Those we kind of call the alternatives, which could be anything from real estate to gold, silver, just kind of very select pieces. But I'll kind of draw that as well. Okay. The other thing too is, remember, your 401k is not part of your company. It's a third party. So it's a company that your company has chosen. And, usually it goes to who knows how many people they get, plan choices from. They might have, picked the top 3 and chosen the one that had a good, average of choices versus cost to the employer. So, they're looking at a lot of different things, but cost is always an issue. They definitely, and so the employer does pay to give you access to the plan, but one big misconception is you pay for those choices as well. So that's what's important to remember is if you're paying to use this 401k, then we want to make sure that while you're putting your hard-earned money in, that you're not overdoing it. And so we'll talk about that. And also they typically don't give financial advice unless you kind of upgrade your plan or choose to search elsewhere. So you're kind of on a very basic platform where you just have to pick and choose. So the first thing is, what is one thing you can do now, no matter how old you are, and we'll talk about that, because whether you're 20, 50, or 60, there are different options for you. So basically, when you move over funds from a 401k, if it's allowed, if your plan allows it, or if you've reached the correct age, there is not going to be any tax consequence. So typically, what you'll want to look at is rolling over that money into an IRA. In some cases, if you have after-tax money, which a lot of people don't know why they have after-tax money, it usually comes in the form of 2 vehicles to get there. If you've been at your employer for a long, long time, we have a lot of clients that have been at their careers since the early 80s and sometimes even sooner. Money that got put in pre-1986 often has an after-tax portion, and so there's a component of that could actually come out after tax. Some of you may have already depleted it by pulling money out, and maybe you didn't even realize that there was that after-tax piece. But if you still have that in there, we can actually move that out and convert it to a Roth at the time. And so there's a couple different moving parts to that. But the benefit to that is then you've now converted that money to a Roth with no tax consequence, maybe not even realizing you had it, and that will now grow tax-free from that day forward. Whereas that's not quite the case when it's tied into the 401k. It does have other tax consequences on the growth under the 401k. So the point is, what we're looking for is how to make it better. So I would say on this particular slide, the key takeaways here is, if you have old 401ks, so let's just address that. Let's say you had a job in college and you put some money in a 401k, or you bounced around from jobs, or you were laid off, or you quit, or you got fired. It doesn't matter the reason. For you and your spouse, any of those old 401ks, you're paying to have them essentially invested without much help. And where you could benefit yourself is you can take all of those and just open one IRA, and in that one IRA, they're just going to dump in. So now you don't have to log into 10 different places, 3 different places. You have one place to log in. And by having a bigger chunk of money in that one place, your advisor is going to be able to now save you fees possibly, depending on what you're doing, because the more you have, sometimes your costs can drop. And they're also going to be able to make sure you don't have something called overlap, where, being truly diversified means you kind of know where all your money is. So when you hear that term, don't put all your eggs in one basket. We'll just talk about this briefly before we go to the next slide. What they're really trying to tell you is it doesn't mean to have 20 accounts all over the place, like back in the day when maybe your parents or grandparents didn't trust the banks and they wanted that FDIC insurance. They had, my grandfather had probably 5 bank accounts, even though he didn't hit the maximum. He just wanted to spread it out, which makes it really fun when you're trying to figure out where your grandparents have money when they do ultimately pass, right? So that's something you don't need to do these days. If you have one good advisor that is breaking your assets up, they're the ones steering it to make sure you don't have all your money in Tesla or all your money in Apple or all of it in growth stocks. We're going to diversify it. So that's the most important thing there. Okay, so this will probably answer some of the questions or help give people just a little clarity. So let's just do a quick little, I'm just going to draw a couple things here. So this is kind of an idea of how we advisors think about diversifying. And basically, when you break it down, you're going to have the U.S. stocks, and there's going to be growth and value, and there's going to be large, medium, and small cap. And then you have, of course, international, and you have your fixed income. This is like more cash, CDs, bonds, annuities, things like that. These are the things that you don't have to worry about as much necessarily. So a good portfolio is what we're really trying to achieve when we're investing. What all of our clients tell us is they usually are worried about 2 things, risk and return. Okay, these are the 2 key ingredients. So if I was to ask everyone on this call what's more important, risk or return, most people will have a hard time with it, or they'll throw out one answer. But so we want to kind of get down to the way we think about it. Return comes by being invested, but risk is what's going to keep you up at night. So what we really want to do is learn how to mitigate what causes you to go into that emotional reaction where it becomes this black and white. I'm either in or out, because that's what gets us into trouble. We make money by being in the market, but to stay in the market, we have to be comfortable, right? We have to feel like we can do this, we can get through it, and that's where we help steer people. So if you have a good advisor, 90% of our job really is helping you with this emotional hurdle everyone goes through of how to maintain and stay through the tough times, and when you're hearing all this noise coming at you. So if we look at the breakdown of diversity, a growth stock is really a company that is essentially worth more in their shares outstanding than they're actually worth necessarily in reality. So the growth stock is essentially, there's more stock outstanding than the company's worth on paper. Let's think of a good example of that, Yahoo. When Yahoo first came out, it was a great idea. People really embraced the idea of email and having this homepage where they had ads and all this stuff. But if the idea failed, did that company have any really value, like, maybe vehicles or buildings or property? Probably not. So it was very earnings driven. If they weren't making money, then that stock was going to drop really fast. So I like to think of this as, if you think about it, if you have kids, this is what it's like when you have children. In a sense, you're putting all this money into them, right? Hoping that they eventually get earnings one day and they can move out again, okay? Now, if we flip to the other side here of value stocks, this is where Warren Buffett made his fortune. There's a book out that all they talk about is value investing, and these top stocks are inherently more valuable on paper than the outstanding shares. So they're in the green, if you will, okay? And so what they are really doing is they're also paying dividend quite often because they have excess cash. So growth and value tend to move opposites. Sometimes they move together, but we never know who's going to be in favor. So the key takeaway here is you want money on both sides. Then, of course, you have large, medium, and small, and I'm kind of going fast here. large cap or anything over 10 billion, 2 to 10 billion, less than 2 billion for your small cap. Why is that important? It's important because risk is involved. So the way we steer how much risk is in a portfolio is, if you think about it, would you rather put all your money in little companies or big companies? If you had no choice, what would you feel safer? Well, most people will tell you that the bigger companies, whether we like them or not, could be a little safer. So the way we control risk, which by definition is fluctuation, okay, is by simply how much is allocated to each of these boxes. If we want to put our foot on the gas, we put more money down here. If we put our foot on the brake, more money up here. So this is how we steer your risk profile. That by being invested, you're going to make return. Of course, over time, the more fluctuation you can handle, commonly, the more return you make. So it's not super complicated, but what's important is you need to have the ability to invest in all these pieces. What most 401ks tend to be very heavy in is this box. And we're happy to analyze your 401k, but you've got to have access to all these areas and be in good choices, of course. International is the same thing. You want to have a little bit in international. And then you might want some or a lot of fixed depending on your age. So that's the basic idea. Now, I'll show you one more thing before we end on this part, is you hear about rebalancing. So let's try to prevent a common mistake. I'll just get rid of some of this if I can without completely ruining the slide here. Okay, so when you think about mistakes people make with your 401k, what we try to help people prevent is really, if you start with an allocation where you have a certain amount of money in these boxes, this is a human nature problem, okay? As things evolve, so we're going to set your risk profile by putting certain numbers in these boxes, okay? So that establishes how much fluctuation you may or may not have. But things are going to evolve. This is going to grow. Let's say this now makes up 50% of your money. It went really well. These are down. Maybe down 10%, down 5%. So if you think about it, we'll go back to a kid example. Do we reward our kids that are doing well in school or that aren't doing well in school? Often the ones that are doing better, right? Well, you got to be careful with that in your portfolio. You actually want to sell the ones that are doing well and buy the ones that are down, because that's the philosophy, right? Sell high, buy low. You don't want to be buying low and selling high. But that's what people often do, is they say, look how good this is doing. I'm not going to sit around in these slow stocks. I'm going to just pile it all into this bucket. And what they've really done is they've taken their risk that they always talk to us about, and they went from this to now a very volatile portfolio. So the act of rebalancing is resetting. It's like those video games where you get to get your 3 lives starting over, right? We get to hit reset, put your risk profile back, and this is a non-emotional component. If we get emotional, we're going to end up piled in one corner wondering what went wrong when 08 happens again, or when COVID hits and we're all in the travel sector and everything falls apart overnight. So we have to be very careful about letting emotions invest. Hopefully that makes sense to everybody. And the last piece here is, people always ask us, and this is important, is, well, there's all these places I can invest my money. How the heck do I pick somewhere? So if you're going to move money from your 401k to an IRA, or you're going to retire, what do you ultimately have to pick from? And I tend to break it up pretty simple. You have banks and credit unions. You have your big firms. These are like your UBS and JP Morgan and Merrill. So there's the big firms. Then you have your kind of wirehouses. And then you have private firms, which is what we are. And then you have mutual fund companies. Let's just walk through this as fast as I can here so we don't put everyone to sleep on my drawings, okay? So banks and credit unions. Look, I will say, to start with this, they're all going to be great advisors at all these places. What it comes down to is what suits you. Banks and credit unions typically have a little bit less selection just because of the nature of their business. They're more of a, we do it because we're here and we can. They might have, on average, maybe in the 1,000 choices to invest in, whereas your big firms typically have about 15,000, like us. And then you have the wirehouses. These are, kind of like a little bit more geared towards do-it-yourself, maybe your Raymond James type firms, things like this. And then, of course, the mutual fund companies. This is what you guys kind of know if you're in a 401k, your Fidelities, your Vanguards, your T. Rowe. You might have a 401 in some of these. So what's the difference? Well, the way I like to look at it is those boxes I drew on the previous slide. I want to fill them with the best of everything I can, okay? I like to have the ability to pick from everything in my world. And I want to keep my clients, when possible, in that top 1 to maybe 5% of investments to pick from. So having the selection to pick from, whether you're at a bigger or private firm, is a benefit. So a good example is this Fidelity. Are they the best at every category? They're good. They have some great choices, but there are plenty of firms that are at the top. So I would never want to be stuck just picking from one mutual fund company. Well, Vanguard, Fidelity, there's hundreds, American Funds, PIMCO, MFS, the list goes on, Franklin Templeton. There's so many to pick from. Our job is to help you weed through that so that you're not just buying out of one bucket, but you're spreading your horizons to be able to now pick from everything. So that's one of the key reasons to do a rollover, is to now unleash yourself from being with just one company. Now, does it mean you couldn't do well at any of these? No, we're just trying to expand to give you better options. The big difference between the big firms and the private, most commonly, is the big firms do have proprietary funds, which most private firms don't. Doesn't mean, again, that they're bad. Some people do not care for proprietary because they tend to, in some cases, they can be a little bit of a conflict. It's like, well, are they only selling me this because they work at Wells Fargo or at Morgan? Why are they not putting me in other stuff? So that's something to consider. We don't offer proprietary funds. A lot of people will say that it's better to pick from just everything. So those are kind of the big components of where to invest. So I think we'll leave it there for now, Marche.
Yeah, the question was about those wirehouses. How are they different from the private and the big firms?
So the wirehouses are going to be similar to some of the firms. It just depends which wirehouse. Some of them will also be very proprietary, meaning that they're really selling you what they produce, and they're not really going out of the boundaries. So you have to be careful that they also could be fairly limited. Some of them have started to expand to where they'll bring in other investments, but I would say the biggest thing is they just tend to be a little more self-service, and they tend to be like kind of that do-it-yourself mentality, and might not have as many choices.
All right, thank you very much. Well, thanks for the demonstration, and we'll just move on with some more information about 401ks.
So some of the rules have definitely changed. One thing to keep in mind, we see a lot of people that have opened multiple IRAs over the years. They might have a tax person or some advisor, or they've rolled 401ks from a place into an IRA, and they end up with lots of IRAs just at different places. There's a couple pieces to this. It used to be if you were contributing to an IRA, so you might have opened up an account that you wanted to put money into, that you could not roll money into that same account. So the government was forcing people to have one that was kind of a bucket for all those 401ks to feed into, and then they had to have another one that they were putting new money into on a yearly basis. That no longer is the case. So the point is, if you have more than one IRA, you can basically bring that all into one place, and that should also save you some costs at the end of the day. So that's one thing to consider. The other piece, you want to go back for 1 second? Okay. The one other added piece to that would be that as you get more money in that IRA, you're going to have the ability to get sometimes better investments that have minimums. So there are some investments that have certain minimums, and when you can collect all those, it's going to essentially help you lower fees and maybe get access to things you wouldn't normally have by having it at all these different places. And plus, you just don't have to log in everywhere. So that's another good benefit that we like. Okay, go ahead. So examining your current 401k, what we basically do is say, look, let's look and see what your choices are. and look and decide, is a diversification withdrawal or rollover something that would help you? And so what we would normally do, and what you can do, is usually on the loans and withdrawal sections of your current plan. So if you have a current employer, you can see or check with them, how much can I take out to roll over to an IRA? Now, some of you, there's no set formula to this. It's just one of those things we have to really look it up, see what they allow. Basically, once we know that number, let's just use an example. Maybe you have 100,000 in your 401k. They'll let you move 50,000 over. So what would happen is your advisor would open an IRA. They'd put that money in there. And then basically the 50,000 would come out of the 401k with no tax consequence. And then we would be able to invest that into some areas that maybe your current plan is lacking. So that the idea is between the two pieces, we're essentially creating a better allocation, hopefully, for you if there's some weakness in there. And if it's not, weak on diversity, then we might just say, hey, well, what other things do you want to do? Do you want to try to pick some things that are maybe a different strategy than what your plan has? So those are really important things. Sometimes people also have after-tax money. So this is kind of getting into the weeds a little bit more. If you do have after-tax money, you can use that to really do whatever you want. You could pay some bills down and take the pre-tax and move that to the IRA, and whatever portions after tax could go to you. You could use it to pay off a loan, or the third thing would be is you could put it into a Roth, and so that's an option. I think we talk about that a little later. But another piece is if you have a lot of company stock. One of the things that happened years ago, if you remember Enron or Global Crossing or some of these companies that really had large bankruptcies, is they were forcing people to hold larger amounts of company stock. That has been, alleviated by the government. They're now not letting companies do that to employees. But if you choose to own a large position of company stock, there can be pitfalls of keeping it within the company. And one of those things are your company stock is quite commonly in a stock fund. So you don't own technically individual shares. So what does that mean? So let's just give you an example. You work for Acme Company, okay, and you have $500,000 in that stock because you just love it. You've been there for 30 years and you just believe in the company and you don't want to get rid of it. So we would say, well, although that's considered very risky, because you're relying on your pension, your 401k, your income, and possibly your health care, all from that one company. If anything goes wrong, you don't really have control over how fast things could go the wrong way. So we always tell clients, be careful with that. If you're going to do that, how could we manage the risk of that? What could we do? And one of the things we could do is, if you could move some of that company stock into that IRA, it would convert to individual shares. And so what's the benefit to that? Well, when you hold it in the stock fund, if something goes wrong at 7 a.m. with the market, with your company, unfortunately, you can't sell that till the close of business in the company stock fund. So you're essentially trapped until the close of business. You're at the mercy of whatever happens, right? By moving it into and converting it to company shares, now you can sell it immediately within, as long as it takes you to get your advisor on the phone and say, hey, please sell so many shares. So that's managing risk. There's other things we can do that are much more complicated with options where we can, put some protection on large positions if it drops quickly. The third thing is people don't realize is the company stock fund does charge a small fee. Now, it's not a lot, but if you have a big position, if you move those stocks out of there, most advisors will hold a fairly sizable stock position and not charge you, which could save you $300, $400, $500 a year in fees that you're just paying unnecessarily. So those are some things that a lot of people don't realize. So I think we can go to the next one, Marcia.
We did have a question here. So basically this, looking at your current plan, is that the same thing you're doing looking at the old plan as well as far as its diversification?
Yeah, so whether it's your current plan or an old plan, what we ultimately want to do is kind of take a snapshot of what you're doing and give you an idea of where we can prove it. We'll actually run it through kind of like an analysis. We have a way to do a report to see the strengths and weaknesses of it. We can show you that. And then what we ultimately do is then say, okay, here's what we suggest. And there are a lot of moving pieces to this. So that's why, like, when people don't engage with a financial advisor and sit down and have the conversation, it's hard because it is a lot. But some of the things we look at is like, if you're contributing to your plan right now, is there a match? What is the match? If they're only matching you for 3%, but you're contributing 10, a conversation we might have is, well, why don't we keep your 3% going in and start shifting some of that excess non-match component into an IRA where you have control over the money and you're not stuck in that 401k. Remember, with an IRA, it is really self-directed. You hear that term, self-directed IRA, but it doesn't mean you're in it alone. If you're working with an advisor, it's kind of self-directed with help is the idea. And so we would look at, doing something like that where you have two pieces going in. Conversely, if you don't get a match at all, well, then we might want to talk about why are you even putting money into the 401k, and that might depend. The 401ks do allow a slightly larger contribution amount, but if you're only putting in up to IRA limits, then you might look at the IRA as your main contribution vehicle. So there's so many pieces that we can get through, but ultimately we'd look at it, or any advisor, obviously you could have them look at it, give you an analysis, decide if you want to do an in-service rollover, which I would say probably a third to half of our clients we bring in via this initial transaction. You don't look for an advisor 2 days before you retire. The goal, and we try to encourage people, is start having this conversation ideally when you're just starting your first job so that you go into it not making these mistakes or knowing how to maximize every area you can, right? So that's really important, I think.
I know that we've already covered a little bit about the in-service withdrawal option. Is there anything here that we haven't covered?
Yeah, there's a couple pieces. So the first thing is the in-service withdrawal option, and I'll repeat it because everyone gets stuck on this. There is no tax consequence. We would never suggest you do anything to do a tax consequence. And anyone considering a conversion to a Roth, have a conversation with somebody who's not just trying to get your account to open a Roth for you. And I say that, because it does happen. You really want someone that's going to really analyze it and look at, is this suitable for you to hand all this extra money to the IRS in your state today versus just paying the taxes way down the line. And a lot of people get caught up in some of these tax changes, but it can really be costly to do that. So be careful of that. Secondly, how much can you take out? I touched briefly on that. Depending on your company, you may or may not have the ability if you're under 59 and a half. Okay, so we'd have to check that depending on where you work. And then that amount would just be random. We'd have to see what it is. Once you hit 59 and a half, however, then you should be able to move your entire plan into an IRA, continue working, continue getting your match. It shouldn't disrupt any of that. So essentially, you have that ability to kind of free it up at 59 and a half. Sometimes at 55, they will also have an added amount you could take. So if you did a withdrawal at, let's say, 50, and then you wanted to see down the line, could you do it again? Quite often you can. And then, some people are worried, well, I have a loan on my 401k. The loan will not affect whether you can take an in-service diversification withdrawal.
All right. And so just to clarify for a question in the comments, this has to do with a current 401k at your company.
Okay, wait, clarify the question one more time. Sorry.
So the question was the in-service withdrawal option, that's only available if you have a current 401k at your company, correct?
Right. So if this particular option, and I'll just kind of try to simplify it. So if you're currently working somewhere, you have a plan you're contributing to, you may have the choice to move some money out and into an IRA. That's that part. With your old plans, the ones you collected when you had your first Starbucks job or you were working somewhere, all those old plans that are left kind of orphaned, if you will, those are the ones that you can absolutely move over. It's just a matter of, talking to an advisor and saying, hey, I'd like to, go ahead and roll this to an advisor, and then they'd ask you where, you'd give them a bank name, and you'd have an account where it would end up. So that's the kind of two moving parts there.
Thank you. I just a comment that maybe someone else in in the audience is asking the same question. There's lots of information in here. Will we be able to get access to this information later? Yes, we will be sending out a link to the replay of this event. So don't worry if you haven't had a chance to take as many notes as you want, you'll have a chance to review this. All right, let's go ahead and move on to 401k loans. What about 401k loans?
Okay, so this is definitely a hot topic for a lot of reasons. What is a 401k loan? Well, basically, you're being led to the belief that you can borrow money from yourself, and because you're such a good steward of your money, you can pay yourself back with interest, and you're going to end up in even a better place, is what a lot of people think. Unfortunately, anytime the IRS gives us a friendly option, you always want to ask questions. Why are they letting me do this? Okay, and if you see that first bullet point there, you're going to be taxed twice on that money. Okay, so let's talk about this. This will be the brain exercise for the day. So if you put money straight from your paycheck into the 401k, you never paid taxes on the money, right? Okay, so now you've funneled all this money into your 401k, you have a nice $80,000 in there, and you decide, hey, I want to pay that credit card off that I'm paying interest on, which may or may not be wise depending on your interest rates and everything, but here's the situation. When you borrow that 10 grand to pay the credit card off, now when you pay the loan back, it's not coming out of your paycheck, it's coming out of your wallet. It's coming out of taxed money. So if you borrowed 10 grand, it might cost you 12 or 13 grand to put it back now, okay? So then you've replaced the money, but you threw an extra chunk at it, which was essentially your after-tax difference there. Now, years later, when you're retired and you go to pull money out, they're going to do what on that money when you pull it out? They're going to tax you a second time, okay? So this is the thing a lot of people don't know. I'm not saying it can't be super helpful for people that are using that to buy a home or helping their kids with college. I'm just saying that this is one of those things where what I always tell my clients is whenever you're going through a big decision, taking a loan, moving, a major life transition with money, is have a conversation with someone, because there's so many options these days for reasonable interest rates through different, banks and even your credit cards, depending on what you're trying to do, that sometimes it can make sense not to go this route. If you've done it, it's okay. Let's just figure out how to make the most of it. One thing I see quite often, a big mistake, is there will be people that work at a company for quite a long period of time, and they might have a buyout offer, or they might have a job offer, and they essentially turn it down. You maybe even haven't been at your job that long, but you think because you have a 401k loan that you're somehow trapped at your company to where you have to pay this off first. So let's just talk about that briefly. If you borrow the money, you've borrowed it from yourself, basically. You didn't borrow it from a bank or a creditor. You are the creditor. So if you don't pay it back, what happens? Well, what happens is, let's say you borrowed 10 grand, you've paid half of it back, you want to retire, quit, leave, whatever. You're going to have a $5,000 balance. You walk out the door. You have a few choices. One, you could keep making payments on it out of your wallet again. Remember, it's that tax money. Because of that, I've pretty much, depending on the amount, I've encouraged people quite often to just let the loan go, and it will be a taxable event. Meaning on that 5 grand, maybe you'll owe, depending on your tax bracket, maybe you'll owe $1,000 and you're done with it. So you just let it be a taxable event. It looks just like you took a withdrawal, and that's something that at any age would be possible. If you are lucky enough to have this situation happen and you're separating from your company the year you turn 55, then you don't have to worry about penalties. You only pay the taxes. If it's under 55 when you separate, then there would be a 10% federal and possibly a state penalty depending on where you live. So this is something that obviously if you're looking at doing, just don't think it's going to block you. I think that covers the basis of the loans. So working with an advisor, really what we're trying to do, I think just in summary, is look at what your current 401k is. What is the match? Should you be using more than just the 401k to save? In my opinion, yes. I think having a kind of a dual plan where you're saving in both can be very helpful. Moving that old retirement plan to an IRA is a way to just make sure that your stuff's being monitored and balanced and properly allocated, and it's being watched all the time. It's not just left in some plan. You know, we ask clients all the time, when did you pick these choices? And they look us in the eye and say, I don't know, when I was 20. It's like, well, you're 40 now. You know, those choices you might want to update. So this is something we avoid by making sure you're doing that. And then, of course, if your plan lacks in some slice of the pie, we can help by, you know, adding pieces in where your plan is limited. So I think that's really the summary there of the takeaway.
All right, I believe we're going to go ahead and open it up for questions. And so I've had a couple come in. The first one is, if you have a 401k through an old job with the state, and you now have a TSP, a federal TSP, would it be better to open a new IRA or roll the money over to the TSP?
Okay, so that's a great question. So if we go back to the beginning, inherently 401ks, TSPs, 403bs, all these plans have similar strengths and weaknesses. You know, they're obviously super accessible. They're usually very simple, and we didn't even go into some of the, you know, the investment things too detailed on those. But if you just think in simple terms, if you want all the choices under the sun, an IRA is going to be that bucket. So the way I explain it is, as you move from job to job, just think that money dumps into an IRA. Because if you move that old IRA or that old 403b, for example, to your new TSP, you've now, in a sense, locked it up until you leave this next job. So I think that's a common thing people do, is they just keep pulling that money and adding it to their next employer plan, and they just keep restricting themselves. Whereas when you have that money under an IRA, there's just, and I didn't even get into all the choices on, you know, the fact that you can withdraw differently in an IRA. There's all sorts of other choices you should be aware of. So that would be the simplest way to explain that.
All right, here's another question. What sort of IRAs are there? Are they both pre-tax and post-tax ones? So I know some grow tax-free, some you're taxed when you withdraw at retirement. So can you go over the different types of vehicles?
Yeah, there are a lot of IRAs. I think the simplest way to think about it is all these company plans we're talking about ordinarily are primarily pre-tax. So you're normally going to push that into just what's called a traditional or rollover IRA that is essentially a bucket that any of those plans can feed into, and that will keep that tax deferral for down the line when you pull the money out. And like I said, some people will, you know, start kicking around these ideas of a Roth conversion when they do this. That's something, like I was explaining, be very careful about that, because you're going to give up a lot of your principal, and it can be a very costly thing to do, to where you might never catch up, or you might never be in such a high bracket that it's worth doing. And we find that that's the case for the majority of people. But a lot of people do this thinking, you know, this is the best thing under the sun, and it usually isn't. Now, the Roth IRA is going to be your one that is not going in pre-tax. It's going in after-tax, like I was saying, kind of out of your wallet. This is usually a great choice for younger folks that are just starting. They're scared to save. They want a vehicle that they might need to tap into to buy that first home or for education expenses. It's got some flexibility there because it is after-tax, where you can always access the principal you put in, whatever you contributed, but you must leave those earnings at least till you're of, you know, age 59 and a half. There's a few variables there, but so that way someone could be saving and packing money away. Like, we get people that are always telling us, hey, I'm worried that if I put money in here, what if I need it? The Roth is a great way to do that. But for many people, they might make too much where they don't qualify for a Roth, or it might not be beneficial to them, but it usually is better to do when you're young and earning less in many cases.
Can you talk a little bit about what does the process of a rollover or a conversion look like? You know, what kind of, you call your advisor up and say, I want to go ahead and do a rollover, and then kind of what does it look like from there?
Yeah, so this is something that, we tend to think is a process where you want the advisor involved. If your advisor kind of puts it off on you, I would say you might consider getting someone to help you that's a little more hands-on. We like to be part of it because you don't know what you don't know. So what we would normally do is call in with you. The first thing is usually to try to log in together where, we can hop on your website, take a look at what's going on, get a good starting idea. And then once we know that, we put a quick phone call in and we're going to find out what you have available. Many companies these days make it as simple as a 5-minute phone call. Hi, this is Sean. I have our client on the phone. They would like to find out what's available. And once they give us an amount, we then say, okay, we want to roll that over to the IRA. We give them an account name and sometimes an account number. And then basically they're going to send you a check, usually regular mail, or they'll sometimes UPS it to you. And then once you get it, you can look at it and you call your advisor and they should send you a prepaid, overnight label to send it in. And then basically once you get it, you just overnight it and it gets deposited into your IRA, no tax consequence. So that's another big misconception is you can't have it go to you. What you can't do is put it in your checking account in your name. It's got to go to an institution. And you should, and just with all the fraud going around these days, a note on that is it should always go to an actual institution, like a bank name. It should never go to a person. Okay, that would always be a huge red flag, just as a kind of a safety tip, is never have it go to the financial advisor's name. That would be very bad. But it's a very simple process. Some companies require a form. I just did one the other day where it was about an 8-page form. We filled it all out. The client signed it. They mailed it in. And the same process. It was all sent in usually within a week or two.
A question here is, how do you actually know what sort of, what you have in your 401k? How can you know that if you're looking it up for yourself?
Okay, well, that could be a couple different things they're asking. Are they asking about what's available to move or the investments? What's available to move?
They're looking, I believe they wanted to know what type of investments they are invested in.
Yeah, so, commonly what I would say is, when we help somebody is we usually try to get online with them if they have a login. Most places do now. And then they can view all the choices they have available versus what they've actually chosen. So we would first look at, hey, you have 30 choices to pick from. These 5 might be great for you, but you're only in 2 things, and we want to kind of expand that. And then that's where we would also look and see, how much could come out and whether they'd want to do that. But it should be all online, or worst case scenario, we'd call in and talk to them.
Here's another question. Does diversifying your portfolio come with extra fees?
That's a great question. So, fees are always a hot topic with people, and here's how I'd look at it. I've been doing this for quite a while now, and I've done many of these 401k rollovers. The common thing that people tell me that we're nervous about fees is they start to see as time goes on how we're doing compared to their 401k. And they realize that, and I think what a lot of people don't realize, you are paying fees in the 401k for sure. Now, could you do it super cost effective in the 401k? Yes. What is the downside to that? Well, it's hard to answer that in a simple answer, but in general, what I would argue is we can usually do the fee structure similar. And I would say in some cases it would be about the same. In some cases it might be a touch more. And often I would argue we've been able to do it for less. It just really depends on your plan. The fees are so all over the place with 401k plans that, it's a hard one to answer. But I wouldn't say it's additional fees necessarily. I would look at it as more this way. If your plan is inefficient, the way I would put it is, what is the cost of you not getting good advice on all that money you've saved up now because you're relying on a plan that's fairly limited and maybe not in what would best suit you? So our job is to try to get you into better choices so that the fees become really the least important part of the conversation. It's more about how you're going to get to your goal, and are we performing in a way that you're, really happy with? And I would say that when I think about our clients, I've always had people, quite frankly, calling me up saying, hey, how do we get more out of here? So if that helps put a little perspective on it, we can always sit down and get in the weeds, but that's the basic way I'd look at it.
And so any advisor you're working with would be able to talk to you about, those specific fees and why it makes sense in most
Right.
cases to move it over to an IRA because the IRA is going to perform better and the fees, regardless of the fees. So.
Yeah, I mean, any advisor has the ability to aim for super cost-effective things and try to find you a portfolio that would be similar in cost. They have that ability. And to your point, and I wouldn't want to even say that we're going to do better 100% of the time. I think it's more of aligning your risk and return with what you're comfortable with. So here's a way to think of it. If you were paying 0.5% in your 401k in 2008 and you had a 50% drop versus having a 23% drop in 2008, you were paying 3%, which would you choose? That's just a way to put a little perspective on it. And that's an extreme difference, of course, but I would say that many advisors, have the ability to try to improve your odds and lower your risk profile.
Well, this has been such an interesting conversation, and we want to thank our participants. Really great questions. As I'm doing the outro, I know probably some of you might have a question. We may not have been able to get to it. Go ahead and leave that in the chat, and we will reach out to you after the event. And make sure to put your phone number in there as well so we know who to contact. Well, on behalf of Advice Chaser, thank you, Sean, for being here. Thanks to the organizations that have worked with us to bring you this webinar today. And as I said earlier, look for an email for a replay of this event. And you're welcome to share that replay with your friends or family or colleagues. Here at Advice Chaser, we're all about helping you find a financial advisor who is a great fit for your life, your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone that we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Bye, everyone.
Bye. Thank you.